Hello, everyone. Kyle Shimoda, Wealth Advisor with INPAC Wealth Solutions. I'm excited to have Jay Mooreland here to talk on a topic that I find extremely interesting. Jay is a behavioral economist with a Master's of Applied Economics from the University of Minnesota. Jay's been in the industry for over 21 years. Without further ado, Jay Mooreland.
Hey, Kyle, thanks so much for having me here. Thank you for your time, investing your time to learn more about how mind games, how games that our mind plays influences our decision-making process. So we're going to go through a few of these today. And Benjamin Graham, he's the father of value investing, said that the investor's chief problem, even his own worst enemy, is likely to be himself. And I just have to look at this and say, why? Why if, think about the investor, think about who you are, somebody who works hard, who saves. You don't go out and spend every dime of your paycheck. So you sacrifice. You'd think that investors would actually, be their best friend, not their worst enemy. But this is actually a very true statement. And it's really about how we're hardwired. So we're actually going to talk about why this is the case, and then a few things that we can do to help improve our financial decisions down the road. It all starts with mental shortcuts. Our brain loves making these shortcuts. And then also we're influenced by emotions. So with these mental shortcuts, I've got a little game for you. Let's say a bat and a ball costs $1.10 in total, and then the bat costs $1 more than the ball. And the question is, how much does the ball cost? Real quick, what just came to your mind? If you're like most people, 10 cents, right? Very, very easy. That was an easy one. Except that's not the right answer. But yet that's what comes immediately to our mind. Looks right, feels right, smells right. It's got to be right. Let me go through this with you. This is actually not a subtraction question, which is what our brain is thinking. This is actually an algebraic question. So we set it up. The ball is the unknown figure. So we give that the value of X. The bat is $1 more than the ball. So that gets the value of $1 plus X. And then the bat and the ball, of course, are $1.10. So let's put it in an equation. You have the ball, which is X, plus the bat, which is $1 plus X, equals $1.10. And then you just simply simplify the equation and you come out with 5 cents. If you still don't see it, pause it right here and go through the math. You will see it. The thing is, this is an algebraic problem, but our minds are not hardwired to solve problems algebraically because that takes a little bit of thought. We'd much rather it be an easy addition or subtraction question where the answer is instantaneous. This question actually comes from something called the cognitive reflection test. And this is really a test to identify, how do we answer questions? How do we solve problems? By intuition, or do we actually analyze things? And while all of us would like to think we analyze things, the reality is we don't do it. The brain doesn't want to analyze things because anytime it analyzes anything, it requires effort. And the brain, like the body, prefers less effort to more. So unbeknownst to us, even when we're trying to analyze a situation, the brain is constantly looking for that shortcut to end the thinking so it can relax. Now, tell me, can you read this right here? You probably immediately saw that, oh, there's a misspelled word. In fact, they're almost all misspelled words. But once you adjust to this, the odds are you can actually read this. And this is because the human mind does not read every letter by itself, but the word as a whole. And what we recognize here is that the brain is largely a pattern detecting machine. And this is all below the level of our consciousness. Whenever you detect a misspelled word, when you saw the misspelled word there, you probably didn't analyze it at all. You looked at it, you're like, oh, there's a misspelled word right there. How did you know it was misspelled that quickly without any effort whatsoever? It's because the brain recognized the letters and it recognized that it was out of sequence. It was out of pattern. In other words, the brain is constantly looking for patterns. And so sometimes the brain will find patterns in very random data, and that can get us into trouble as well. So here's a question for you about driving. Relative to other drivers on the road, how good a driver are you? Would you say you're above average or below average? This question has actually been asked by psychologists across the world for decades now. And the research or the findings that comes back are stunning. Did you know that well over 80% of the world's drivers are above average drivers? Now, you might laugh, and you should, because that's ludicrous. You can't have 80% above average drivers because by definition, half the drivers should be above average and half below average. But the reality is we tend to think we're better at things than we might really be. And so when it comes to investing, we might look at some good returns that we've recently had, and we might take all the credit for it and say, hey, my above average returns are due to the decisions that I made. So we tend to take ownership of all of our wins or the good things that happen to us. And what we also do at the same time is we deflect or blame for all of our mistakes. If we were to purchase a security and it went down, it would be like, well, you know what, I'm just early, or the market's irrational, they don't know, right? It's never our mistake. So what happens is over time, we tell ourselves how great we are at things, but we don't balance it out with our mistakes. So we can become overconfident in our abilities down the road. And that overconfidence may lead us to take more risk than we're actually comfortable with because we just don't see how we could be wrong. So this is very important. It could help, understanding this could help us avoid a costly decision down the road. And Warren Buffett, if you're not comfortable saying, hey, I don't want to admit I don't know things, Warren Buffett says, look, the most important thing in investing is defining what we don't know. And it's not just what we don't know, but also the experts on TV. You know, all those talking heads that are giving forecasts, they also don't know, no matter how confident they seem. We just don't know. And so when we have that type of attitude, it helps us be a little bit more humble, and that humility helps us think a little bit more critically about our financial decisions. So tell me what's wrong with this statement right here. When I go to Vegas, and I understand you're in Hawaii, so that's a long flight for you, but when I go to Vegas, I like to invest in a few hands of blackjack. What word is out of place there? Odds are it's that word invest. You don't say, I want to invest in blackjack. You say, I want to play, I'm going to gamble, I'm going to speculate, I'm going to lose my shirt in blackjack, right? I mean, there's lots of other words we would say other than invest. We get that, but change this statement around a little bit, and we don't recognize that there's something out of whack here. Check out these headlines. These are newspaper headlines. Investors bet on more pain for retailers. What investors will be betting on next quarter? Should investors bet? When you read the financial news, whether it's the paper, online, whatever, pay attention to the verb that's used after investors. Oftentimes, it is a word like bet. But while just like gamblers don't invest, investors should not be betting, because then you're not an investor anymore. You see, an investor is just a word. It's what we do that defines who we are. If an investor is betting, the investor is no longer an investor. The investor is a speculator or a gambler. But instead of being in a casino, they're using the stock market as their casino. So understand that words truly matter. And the more often we see investors bet, the more often it subconsciously tells our mind that, yeah, part of what investors should be doing is betting. But I'm here to tell you that that's a mind game. Investors don't bet. Speculators and gamblers bet. Investors make calculated decisions and generally are more long-term in nature. So we really want to be careful about the difference between an investor and a bettor and a speculator. It's very, very close. Sometimes it's very much a gray area. Understand that stock prices are often driven by mood swings of investors rather than by the value of the underlying businesses. I mean, think about how much the market moves. I mean, think about last year during COVID, March, end of March into April, market drops 35% in a couple of weeks. Are you telling me that every business there, their balance sheet, everything went down 35%? And then it came back up within weeks as well? Of course not. It's just our expectation and our mood about those companies changed. So if you're investing based upon short-term market outcomes, you're really speculating on how people might feel towards stocks going forward. Now, here's another question for you. Which do you think has the most calories of these three? A Starbucks double chocolate chip Frappuccino, a Big Mac, or a king-size Reese's peanut butter cup? Now, when I've done this in live presentations, I'll actually poll the audience here, and by and large, the majority of people say Starbucks. So if you said Starbucks, you are absolutely in line with the majority of people. But since this is called Mind Games, let me give you a hint, that's not correct. The correct answer is actually the Big Mac. But you know what? We know through lots of research that Big Macs are really caloric, and so we don't really think about that. What happened was we think about what we've heard most recently, which is that some of these drinks that we've never thought of before are really high in calories. So what we learn here is that sometimes our brain does not answer the question at hand. I asked which has the most calories, and what the brain answered is, what have I heard most recently has a lot of calories? That's what the brain answered. And so we learn that whatever the media is paying attention to can influence our perception. We believe that it's going to be more likely to happen and or more likely to be true. Very important point. So an investor might say, hey, everyone's talking about this investment. It must be going somewhere. So if you've had a conversation recently with a friend or even with Kyle or somebody else about AMC, GameStop, Bitcoin, or Tesla, then this is exactly what I'm talking about, is that whenever anybody's talking about something a lot, it gets us engaged. It makes us pay attention. And we think naturally that a certain outcome is going to happen. So we need to understand that the mind game is that we tend to make decisions based upon information most available to us. And that just because a story or a headline is repeated often doesn't make it true. But that's the game. The more likely, the more often we hear something, the more we believe it's going to be true or likely to happen. So let's talk a little bit about emotion. So those were some examples of mental shortcuts that happen in real life. Now let's talk about the amygdala. The amygdala is our fear center. Its primary role is to keep us safe and ensure our survival. So like if we detect a dangerous situation, the amygdala is activated, sends responses throughout the entire body that basically says, get to safety. It's that fight or flight response. Really, it's the flight response, get out of here. And what's interesting is that neuroscientists have found through functional MRI, that's imaging of the brain, that when people are experiencing financial loss, their amygdala is activated. And the response from the amygdala is the same no matter what triggers it. It's get to safety. So how do you get to safety when you're losing money in the market? You sell, right? I mean, that's the natural thing. Get me out of this. Stop the pain. Sell. So the amygdala can cause us, can influence us to sell low. And at the same time it's telling us to sell and get to safety, it also hijacks our prefrontal cortex, which is where we do all of our thinking, our planning, logic, reasoning. That's the brain we need to make good financial decisions. And yet when that amygdala is going off, that ability is offline. Yeah, it's kind of like literally we might hear something in one ear, out the other. We can't think well about things. That's oftentimes why maybe we're in a heated debate with a loved one, in an argument, we're told, go cool off before you say anything, right? Because when the amygdala is hot, you're not thinking about what you're about to say. You know what you're about to say, but you're not really thinking about it. So similarly with this, we kind of know what's right and wrong, but it doesn't matter. We're just doing what feels good at the moment, when in reality, we need to take a step back and make sure we get our prefrontal cortex back online so we can make thoughtful, not emotional decisions. We also have dopamine in our brain, which is our natural drug high. Dopamine gives us feelings of euphoria, overconfidence, as if nothing can go wrong. And neuroscientists have found through that same technology, functional MRI, that people who were experiencing a financial gain, their brain was lit up in the same way as somebody high on cocaine. In fact, they couldn't tell the difference between two brains. So yes, we literally can get high on gains. And so that causes us to underestimate the risk that's out there and may cause us to take on more risk, right? This, as you can see, this plays into some of the overconfidence that we talked about a few minutes ago. So Warren Buffett was asked many years ago, what is the key to successful investing? And what he said was, you need the temperament to control the urges that get other people into trouble in investing. He says it's not about IQ. Once you have a base IQ, that's all you really need. It's really about the ability to control the urges. It's not about not having the urges, because if we're human and we're not psychopaths, we have, or sociopaths, we have these urges that are healthy and natural. We just simply need to learn to control them. That is the difference between a very successful investor and everybody else out there. So how do we control the urges? Well, first off, having some sort of strategy, an investment, a financial plan, that becomes the anchor. That is telling you where you invest in, why you're investing in it. It's just, that is exactly what we need to rely upon. And then we need to have the discipline to stick with that plan. Now, hopefully you have the plan. That's the base. The discipline is actually harder, because anybody can have a plan and abandon it, right? So this is where Kyle can be of significant help to you, is not just in developing the right plan for you that you can have conviction in and clearly demonstrates what your goals are, but also have the discipline and the thoughtfulness to stick with that plan, even when emotions are high and you're tempted to do other things. So to summarize, first off, our brain makes mental shortcuts. We love them because it makes problem solving super easy, but they can trick us once in a while. The emotional response, it's always going to make us feel better in the moment. So it will always give us temporary relief, but it's going to come at a long-term cost. So I guess the question there is, would you rather be profitable over time and reach your financial goals, or would you rather appease the urge that you're having right now? And so the answer to this is to focus on your plan and maintain discipline to your strategy.